Today, we're going to see an easy method to find the best ETFs based on some simple criteria, and the whole method I'm going to teach you today is going to be totally automated for you. My name is Rick. Welcome everyone. Don't forget to subscribe to the channel if you're new here. And now let's start with a video by setting up a free screener that is going to help you find the best ETFs amongst a jungle of over 9,000 existing ETFs in the world. Even though in this video I'm going to explain all the important concepts and criteria you need to evaluate an ETF, I want to start with something practical. So we're going to jump right away to SeekingAlpha.com, which after a quick and free sign-in is going to look like this. On the left-hand sidebar, you're going to find the ETF screener. So click on it and then just click on All ETFs. This is going to be your black screener. And we're going to set up all the important filters by clicking on Add Filters. The only filters you can set with a free account are ratings. Honestly, you don't need that. So let's start with ETF details and let's select fund types, asset class, assets under management, and expense ratio. Our first four filters are going to appear here. And before adding other filters, let's take a moment to set this up. Click on Edit Filters, and we start with the fund types. Now, I really need to address leverage ETFs because I've been hearing so much about them lately on YouTube, and I know that people don't really know what they're getting into. So, leveraged ETFs multiply the returns of an index. So, a 2x leverage ETF of the S&P 500 aims to give twice the daily returns of the S&P 500. And we also have twice the loss when the index goes down. So a guy asked me, Rick, if the S&P 500, despite ups and downs, tends to return around 10% per year over the long term, can't I just get a 2x leverage ETF of the S&P 500 and get a 20% return per year over the long term? And to this, I have to say, no. Unfortunately, it doesn't work like that. The problem that nobody tells you is that leveraged ETFs reset daily. So say for example that you invest $100 in the S&P 500 and $100 in a leveraged ETF of the S&P 500 with double leverage, 2x. On the right hand side, I just assume possible daily returns like 10%, 5%, minus 4% and so on. And the leverage ETF would emulate these returns, doubling them. So starting with $100 in both cases, at the end of the week, you have $98 with the normal S&P 500 ETF and $82 with the leverage one. So you lost 2% with one and 18% with the other. So doubling the daily returns doesn't mean doubling the long-term returns. And as you can see, you can end up losing much more money than you're ready to. Same thing also with inverted ETFs. So both of them are actually just for day traders or short-term investors. My honest advice, just forget about them and select only traditional ETFs. As for asset class, this is basically a list of ETF types based on all possible categories. For instance, you can choose the market size of the companies included in the ETF, like large, mid, and small, as well as the investment style of the fund, like value, blend, or growth. If you put these variables in a square, you can see that the more you invest into small companies and or growth companies, the riskier the investment is going to be, but also the higher the potential gains. Large companies tend to be more stable and safe, but at the same time aren't going to grow as fast as good small companies. Value companies, which are mature and have stable financials, are surely safer than growth companies like Tesla, but also have less potential to grow. For the average investor, I'd suggest large companies because of the lower volatility. So you could select large blend, large growth, and large value. But since we also want to include global ETFs and ETFs like VGT that contains not only large companies but also small ones, we're going to leave this filter unused. The next point is assets under management or fund size. A good ETF should have a minimum fund size of at least $100 million. But honestly, all the ETFs I invest in manage at least $1 billion. Managing less than this value means there is less interest from investors, and this translates into poor liquidity and wide spreads. But above all, usually the fact that the fund manages billions of dollars is an additional confirmation that it's a good ETF. The next important parameter for an ETF is the expense ratio, or TER, total expense ratio. The expense ratio is the percentage of the ETF value that you have in your portfolio that a fund manager is going to take as a management fee every year. If you have an ETF with an expense ratio of 0.5%, it means that every year you'll pay 0.5% of the value that you possess of that ETF. As a rule of thumb, you should avoid ETFs with an expense ratio over 0.30%. So we're going to set it here. Then let's go back to advanced filters and we move now to performance, where we select 5 years total return and 10 years total return. Although past performance is not a guarantee of future results, seeing how the ETF performed in the last 5 and 10 years compared to its peers is going to help us decide. When setting these filters, I want you to focus on the 10 years return because it's the longest time frame that we usually have available. The 5 years filter is going to be useful if you compare younger ETFs that didn't exist 10 years ago. But right now, we can leave it empty. So, how do we decide how to set this filter? Considering that a total stock market returns an average of 10% in the long term, which means 160% in 10 years, we set here 160% as a minimum, because everything below this value would be for sure less interesting than just investing directly into the total stock market with an ETF like VTI or VO. Let's move to holdings now and select the number of holdings, as well as dividends, where we can choose dividend yield trailing 12 months. When it comes to the number of holdings, the lower the number, the less diversified is the ETF. As a rule of thumb, don't choose ETFs with less than 100 companies because of risk and volatility. The trailing 12 months dividend yield is a filter that right now I'm not going to use because when I look at ETFs, I'm not personally interested in dividends. If you are, then you can just use it to filter the minimum dividend yield that you want from your ETF, but consider that a higher dividend yield doesn't mean a better result. After everything is set, you can see that we went from thousands of ETFs to just 81, which is a very good step. So click on Save, just choose a name and confirm so that you're going to be able to use this screener in the future. Alright, now we have the results of our screen and we can sort them as we like. Let's go, for example, to the tab Performance, and if we scroll to the right and click on 10 years total return, we see that the best performance in the last 10 years has been VGT, FTSE, QQQ, and IWY. VGT giving almost 600% in 10 years. All these first ETFs are based on a growth investment style, which doesn't come as a surprise since in the last 10 years, companies focused on growth have been performing the best. Nevertheless, you can't just use performance as a metric to choose your ETFs because otherwise you would just invest in growth, which is also the most overvalued part of the market. Remember that growth doesn't always perform better than value, and this is mostly given by the fact that the price of growth tends to get overinflated, and when a crash comes, which usually happens, it drops more than value and becomes underpriced. So in order to have a good, balanced portfolio that is going to perform well all the time, you need to diversify, and to see in detail how this portfolio should look like, I suggest you watch this video that I will link in the description below. Getting back to the filter that we haven't used at the beginning, asset class and subclass, now it's time to use it. Because if you don't, oftentimes the best performance are going to be only growth or technology ETFs. So the process looks like this. First, you decide which components your portfolio is going to have. For example, a foundation like the S&P 500, and then a growth part and a value part. And you can do this based on what I explained in the video that I just mentioned before. And then when you look for the best ETFs with the screener that we created, you need to select under the asset class filter either growth or value or blend, because otherwise you'd be comparing apples to oranges. So let's say, for example, that now you want to find a good growth ETF. So based on performance, you see that VGT, FTSE and QQQ are the 3 best performers. Thanks to the filters we set at the beginning, we are sure that these 3 ETFs are all solid choices. In fact, they all have billions in assets under management, a low expense ratio, a good number of holdings, and a great performance in the past. Now we've got to dive a bit deeper into these 3 ETFs to see which one is actually our best choice. And to do this, there are 2 steps we need to take. First of all, we're going to take a look at the official pages of the ETFs by just googling the ticker. So VGT to get to the Vanguard Information Technology ETF, FTSE to get to the Fidelity MSCI Information Technology ETF, and QQQ to get to the Invesco QQQ. The description of the ETFs contains all the information you need, from general information to the performance of the last 10 years, the price, the portfolio composition, number of holdings, sector exposure, really everything you need to know about the ETF. If you check the performance of an ETF, you see that they always show also the performance of the benchmark, which is the underlying index. In big, established ETFs, this difference is usually small, but in general, it's always a good thing to check that the ETF doesn't differ too much from the performance of the benchmark. The last step we're going to take is making a comparison of the 3 ETFs, and we're going to do this with a website called portfoliovisualizer.com. I'm going to write the link in the description below. This website allows you to make a clean comparison of all the ETFs and stocks you want. You don't need to sign in to use it. Simply click on Analysis, then Backtest Portfolio, and then on Open Analysis. Now, I can quickly insert the 3 ETFs, so VGT, FTSE, and QQQ. I choose 100% weight for each ETF in his portfolio, and I'm going to keep the S&P 500 index as benchmark ticker with VFINX. Quickly explained, the page page is going to show you everything about ETFs, including their performance in the last 10 years, including the S&P 500 as reference, but scrolling down, also other interesting information about risk, like the minimum drawdown these ETFs experience, the beta, alpha, and risk-adjusted ratios like the Sharpe ratio or the Sortino ratio. Now, when it comes to finding the best ETFs, the most important thing that you need to do is deciding the structure of your portfolio. And you're going to see how to do this through this video of mine, where, by the way, I also suggest which ETFs you have to invest in. Anyway, if you enjoyed this video, take a moment to check my channel because I'm sure you'll find other interesting videos for you. And other than that, I want to wish you a great day, and as always, I'll see you in the next video.